All right, time now for a special offering, Clutter Breakers. Today, Ekta is standing by the big wall to give us a deep dive on how US dependence on API imports is taking place, the raw materials which are needed to make final drugs, and whether anything has changed since COVID-19. Ekta, over to you.
Thanks for that. Well, pre-pandemic, 80% of key starting materials and APIs manufacturers, the raw materials, which are basically used to make final drugs, were located outside of the US. This dependence was one of the key issues that came to light during the pandemic, which has been described as a national security risk by the US. The key question now is, has the US's dependence reduced? The US government, approximately 3 years since the pandemic began, doesn't think so. A report by the United States Senate Committee on Homeland Security and Governmental Affairs earlier this year has indicated that as of 2021, majority of the FDA-approved API facilities were located outside of the US in India. And currently, 9 out of 10 injections which are used for critical acute care in the US rely on raw material from China and India. One of the key recommendations of the US government continues to be to invest in domestic manufacturing for critical generic drugs. And I quote, "The federal government should build upon its efforts to engage industry and academic partners through private-public partnerships that incentivize strategic onshoring and advanced domestic manufacturing technologies for critical generic drugs." But the steps to shore up domestic manufacturing until now have been piecemeal and inadequate, point out experts. For example, Flow, the Virginia-based CDMO, was set up in 2020 and awarded a 4-year, $354 million contract. But as of last year, the company was still to meet major deadlines. Indian companies supplying to the US say they haven't seen any disruption to their order books either. Reasons include complacency post-COVID-19 to disrupt deeply entrenched supply chains, to the cost advantage, which sometimes can have an over 50% difference in rates, especially in advanced APIs. In fact, some API and intermediate manufacturers have seen a benefit of around 20% due to the China +1 factor. However, while the progress from the US could be slow, this is a space to watch. The US believes one of the reasons for the drug shortage, which has risen 30% year-on-year in 2022, and is at a 5-year high, with basic pediatric flu and fever medications seeing supply shortages, is in part linked to the over-reliance on APIs. And the US is adamant to ease it. Indian companies expect on-ground disruption, if any, to be possibly visible in a year or two. Lastly, experts say the US government is likely to look at a multi-pronged approach to improve the supply chains. These steps could include government fixed contracts, increase disclosures, and provide the FDA more teeth, such as mandatory recall authorities for all drugs.
All right, Ekta, thanks a lot for that. Insightful. We'll take this discussion forward with Aditya Khemka, who's the fund manager at InCred Healthcare PMS, and Vijay, Garg, MD, Viva-API Labs. But Vijay, of course, we know him as the previous head of IOL Chemicals as well. We have a lot of conversation with you during the time, the API prices were surging, and, we saw IOL Chemicals do well as well. This is during the pandemic. So good to connect with you again. Mr. Garg, just wanted your thoughts on what Ekta's put out with regards to a trend, and how should Indian players foresee this?
Thank you very much. See, post-pandemic, what happened, every country has this risk, which every country, even India, has it's a security risk. So China +1 model, which was announced by all the big, you can say all the regulated countries like US, UK, and Europe. See, what has happened, the approach was like earlier everything was going out of US or Europe or UK. But now what is happening post-COVID, every country has now come to know that self-reliance or self-dependence will be the only key. So as Ekta has rightly mentioned, that US government is trying hard to bring back all those drugs to US. But since it's very slow, so we can see in times to come, definitely the self-reliance will increase. Like India, if you see India, Indian government has come up with incentive linked schemes and pharma parks. It is what self-dependence will increase with all these efforts in India. Same is with the US. So now US is looking China plus one model. So where India will be really helpful in providing the complex chemistry intermediates to US, and US will definitely, it will take 2 to 3 years because in pharma generally it's a slow start.
Okay, Aditya Khemka, Fund Manager of InCred Healthcare PMS, also joins into this conversation. Aditya, you've been looking at the entire API space and API stocks very closely. Just wanted to ask you, with your conversations with a lot of these API companies, have they actually benefited from the China plus one factor? Because as of 2021, India had the maximum number of US FDA approved facilities for APIs outside of the US. So is that a real factor which has come through for India? And to the US-China relations, is that actually turning out to be another windfall gain for India?
Yes, so in fact it is. So if you look at majority of the API companies in India, regardless of whether the size of the company, all of them have done significant capex, and they have announced significant capex for the next 2-3 years, and they have done significant capex in the last 1 or 2 years. Now that is obviously driven by their order books. So their order books have gone up significantly higher than what it used to be historically. And to sort of service that order book, they need more capacity. So it is beyond doubt that the China plus one or the order inflow for these API companies has significantly gone. That I don't think is debatable. What is debatable probably is this entire US shifting of the production to US for critical drugs or for some drugs. I think there, in the US, there are two narratives. One is obviously they want to be self-reliant for at least certain critical drugs. The second is that they keep saying that drug prices are too high. Now, if drug prices are high, despite them being manufactured at low-cost destinations like China or India, then bringing the production home to US or any part of the US is going to make them even more costlier, right? So they are not going to have. So you have two parallel narratives, and the narratives don't match. There is no common ground for those two narratives. So I think at some point US will have to decide which of the two narratives do they want to sort of hold dearer to their heart.
Okay. Mr. Garg, now that China has come back into the fray in terms of manufacturing and all of the COVID-19 restrictions have been lifted, what is the change that you're seeing in API prices? Is there a further reduction, say, in the past 2 quarters in terms of API prices?
Yeah, definitely. After China has opened up, now the prices of API, prices of intermediates are going down. Already it has gone down to the tune of 20%, because what is happening now, China, after completely opening, they are trying to get their share back, because in last 2 years many Indian companies has taken position in US market, and to much extent in India as well. Like if I can give you example for paracetamol, earlier India was totally dependent on China, but now more than 50-60% of the production is happening in India only. So that way now China has the only one thing which they have is the price reduction, because they are sitting on huge capacities. So definitely prices are coming down. But looking at the the position which companies are holding for China plus one model, so we expect that the Chinese reducing the prices will not impact so much.
Okay, all right, Aditya, just leave us with some stocks, because the concern is with regards to the kind of correction that we've seen in a lot of these API stocks. Do you think that there's any kind of upside from current levels?
Yeah, I definitely think so. I think the API companies, majority of them currently face some operating deleverage because they've created a lot of capacity, and in the capacity you have costs which have to be upfronted, and the revenue is back-ended. So there is some operating deleverage on their P&L and balance sheet today, which will get resolved over the next 2 to 3 years as the new capacities are monetized. In terms of the portfolio that I run, the InCred Healthcare PMS portfolio, the largest position in the API space that we have is Newland Laboratories, followed by Heikel, followed by Syngene, which has also entered into the API space now. So we are obviously more tilted towards innovator CDMO, so where the API companies are manufacturing the raw material and starting material for the innovator companies other than for the generic companies, because pricing tends to be less volatile there and the order book tends to be more stable there.
All right, gentlemen, thanks a lot for joining in. Appreciate your thoughts.